Modern finance has an incredibly successful track record of funding growth. Over the last century, capital markets developed highly sophisticated systems for allocating resources to build the modern world. During the industrial era, investors learned how to finance massive physical assets, like railroads and power grids. As we moved into the information era, those same markets evolved to fund digital platforms and global software ecosystems. To evaluate these investments, analysts rely on a specific set of metrics. They look closely at revenue growth, profitability, cash flow generation, and historical comparables. These metrics work because they extrapolate future outcomes from observable historical data. If a factory produces a certain number of widgets today, you can accurately model what it will produce tomorrow. Our established system of finance functions as a machine built on historical predictability. It is designed for companies that compete in markets that already exist. But the 21st century is presenting us with opportunities that challenge that conventional logic. We are now attempting to build artificial general intelligence, fusion energy systems, and planetary-scale communication networks. The core valuation paradox is that investors cannot use historical data to evaluate these opportunities because the product being created is the future itself. Traditional venture capital structures struggle to handle these ambitions. A standard fund is designed to return capital within 10 years, which falls short of the 20 to 50-year timelines required to build out quantum computing or space infrastructure. The standard venture capitalist is searching for near-term financial returns. However, the success of frontier technologies relies on supporting long-duration experimentation before conventional markets even form. This mismatch between convention and these century-defining ambitions leaves a void in the market. To fill it, we have to look past quarterly performance toward a different way of valuing what's possible. Emerging patterns of investment behavior point to a new capital allocation model stepping into this vacuum, a framework we can call vision capitalism. The distinction here is subtle but critical. Traditional capital funds companies to capture existing markets. Vision capital allocates resources toward future states, aiming to expand long-term human capabilities before those markets fully exist. In this era, the primary vehicle for investment is the civilization venture. A standard business serves a single market segment. A civilization venture functions as a foundational base that elevates collective human potential and enables multiple downstream industries to eventually take root. Vision capitalism finances the foundational architecture upon which future industries will be built. But this raises an immediate mechanical problem. If there are no near-term profits and no historical comparables, what actually drives the massive flow of investment required? Classical economics relies on land, labor, and capital as the core factors of production. To understand innovation economies, we have to recognize an additional enabling force: collective confidence. Collective confidence is the shared societal belief that a particular future is achievable. This creates a reinforcing cycle. Strong belief triggers initial investment, which sparks innovation and observable results, feeding right back into increased belief. This cycle transforms the role of the investor. They provide the talent, research, and social legitimacy required to will these futures into existence. A bold narrative acts as a hard economic requirement, generating the gravity needed to build civilization-scale technology. If vision capital provides the mechanics for future creation, its objective is the realization of abundance capital. We define abundance capital by its outcomes: universal access to advanced intelligence systems, personalized global learning networks, and reliable, low-cost clean energy. This concept taps directly into older intellectual roots. In 1930, the economist John Maynard Keynes envisioned a future where technological progress would dramatically increase productivity and material abundance for society as a whole. Profit remains an important part of this system, but its role shifts. Instead of being the sole metric of success, profit becomes one indicator among several measures of societal value creation. Success under this economic model is measured by the expansion of humanity's collective capabilities and access to essential resources. There is a historical flaw in how we have funded innovation. Traditional venture capital generated extraordinary returns, but it strictly concentrated those gains among founders and early investors. Civilization ventures, by their nature, require broad societal engagement. The massive scale of these initiatives introduces the necessity for broad wealth participation. Future ownership models may include community ownership structures, citizen investment mechanisms, and sovereign innovation funds to distribute the value created. The 20th century demonstrated exactly how capital could generate wealth. The test for the 21st century is whether capital can be directed to expand human possibility. The challenge for the coming century is whether capital can produce global abundance as effectively as it once produced wealth.